Welcome to a phenomenal edition of Rebellion's educational series. I'm here with the CEO of Clanz, brilliant mind, Dr. Kollo. I've known him for years. He's a quant economist, really fantastic human insight, and also a fellow Cavapoo owner. Dr. Kollo, thank you so much for coming on today.
I especially the last one, Alex. That was brilliant. Thank you.
Both love our dogs. Dog ownership's up to almost 70% in America now, so it's in some parts. So, first question. Let's get to crypto. Let's get to Celsius. What's going on there?
It's a fascinating question. So, Celsius, for those of you that haven't followed the story, was a very popular crypto platform that accepted money from people and essentially made promises of yield. So, kind of like a bank account would. And what they did is they took their money and they deposited it into other things. They gave them yield, what's called DeFi protocols. And more recently, they basically stopped withdrawals. So this is kind of equivalent to a bank that you would have put your money into a quasi savings rate, and the bank is quite risky. So it's kind of lending it out to lots of high risk stuff. And eventually can't get your money back for you, and it stopped withdrawals. And now they're looking at liquidation proceedings. It was a really big deal in crypto circles because it's just one of those institutions that's been around for a while. If you look at the website, which is still very much active, you can see that it's banked on this idea of rebellion, like, don't trust banks, don't trust anyone, give us your money. And, you can have returns and then you can go conquer the world. And a lot of that narrative kind of fell really short of expectations when suddenly they closed their books and went, actually, sorry, you can't have your money back. You can't withdraw it because we're sorting some stuff out. So it was a very typical kind of what would be in the financial markets equivalent of a small bank failure, maybe some regional bank or something that's a little bit risque, and took some deposits and did some silly stuff.
And this is directly tied to the price of Bitcoin, Ethereum, et cetera?
There's certainly links. So some of the collateral and the risks that they were taking were linked to Ethereum and the new kind of Ethereum that's out there. There's a couple of really interesting things to read online on this because it's not a simple thing. But essentially what was happening is they were working off putting their money into a certain class of Ethereum, into Ethereum, then lending out Ethereum, and then taking that lending token back and then doing other stuff with it. So essentially this kind of notion of active trading. If you're a bond trader, this would be equivalent to you saying, I'm going to buy one fund, I'm going to use that fund as a collateral to buy something else, etc. So a little bit of financial juggling there. And then, of course, as soon as there was turbulence and volatility there, and these assets and these collaterals kind of slipped, and some of the pegs slipped as well inside of these trades, they just went wrong. And so it's a misestimation of the risk, I suppose, involved. I think the most, not the dangerous, but kind of the most eyebrow-raising part of all of this are two things. One is in the world of crypto, people make a big deal out of owning your own money. So when you put your money with a protocol, it's supposed to be your money, and you're just kind of letting the protocol use it, but you should be able to recall it anytime you want. And here, this is obviously not the case. And I think, Celsius really took that money. So this idea of decentralized finance, where everything is decentralized, you own your money and your identity, was really kind of not true here, because you had this centralized organization called Celsius who took your money and then you'd never got it back. And then I think the other big learning lesson is, again, just this notion that you're taking risks. Whenever you're doing this stuff, it's not transactionary. You're not connecting like an exchange two people together and saying, here's a trade, but you're creating some kind of forecast, some kind of expectation. You're using words like savings rate, or stable coin, where people expect it to be risk-free or relative to have the same benefits as a traditional institution, which of course it doesn't. And so I think it was a reminder that some of these marketing terms should probably be protected. And I think it was a reminder that we're not quite at this utopian decentralized world yet.
Well, I guess you're hinting at the Terra USD stablecoin issue, but that was a loss of faith. Whereas you would say, the issue with Celsius was really just mismanagement.
I think so. I think that's a good way to characterize it. I think with Celsius, it was risk mismanagement. And I think with Terra, the way that I've come to understand that situation is it was a coordinated depegging. So a bunch of financial agents went in there and put trades on and pushed that peg off and then benefited from it. So it was more of a kind of capital markets action that resulted in that happening versus Celsius, where you have yes, you have a capital market storm that's happening in the background, but ultimately that company mismanaged what they were trying to do.
Warren Buffett says these economic recessions are like low tides, revealing the people who are swimming without shorts, if you will. So, Celsius is not a great firm. Terra USD was, maybe a house of cards, but a Bitcoin itself, when do we start consider buying it? I mean, if the last crypto winter was a 75% drawdown, right, from 17 to 35 or 4, what are we thinking? 15,000 here? Is that for 10,000 as a number thrown around? Have a comment there? Or?
Oh, look, it's a really impossible question to answer in a traditional finance sense. Like, unless you're using technical analysis and you believe in certain structures. We're looking at some prices earlier this morning, actually, of things like Netflix, which is down like 70, 80%, 75, 80% since November last year, which is the same time it started dropping. So all of tech is down, obviously. And except IBM. Turns out IBM is not down, but everybody else is kind of down across the world. It turns out if you don't go up a lot, you also don't come down a lot. But
great. No, IBM's been a dead stock for 20 years.
Yeah, exactly.
Maybe more.
So I think it's an interesting one where Microsoft, Google, Amazon, et cetera, they're all kind of taking a bit of a bloodbath. And you might ask the same question with Netflix, going, well, if you guys are going to be still around as a business, you're going to get subscription revenues. Is this a good time to enter the market after you've been bathed for 80% down? Bitcoin or anything that's a medium of exchange, I'm not going to call it a currency because it behaves like a small cap tech stock. So it is effectively carrying that kind of risk premium, I think, based upon its correlations. But I feel like there's two moments where it could start to reverse. One is simple: traders can think they can make more money by buying it, and there's a bit of a kind of trading game that happens. Or two, we see a lot more companies announcing adoption of Bitcoin as legal tender and currency for purchasing goods and services. So their value in transactions become more significant. People move currency, US dollars, over to Bitcoin so they can transact in Bitcoin to take advantage of those things. That's when you would see a more fundamental kind of demand. But it's very hard to give it a price or a target price. I know JP Morgan tried to do that because I feel like obviously you don't have the anchoring of a fundamental business behind it. So it's purely a medium of exchange. And so in the same way that when you have a currency falling through the floor, unless the government intervenes and slows down the shorting or whatever else to it, it's really the number of people that want to buy goods and services using that means of exchange or that really matters.
It's hard enough for professional analysts to rate these consistent businesses. So then moving from there to crypto, it's almost impossible. Price prediction has been one of humans' favorite tasks, but often with failure. So, I have been following your career for years. I love everything you do. And I want to know about Clanz before we go any further. What is it? Can you tell me a little bit about it for our audience?
Yeah, most definitely. So Clanz is a business I joined in February as CEO. It's a digital asset management firm, very early stages kind of startup. It's been around for a couple of years. It has an exchange product in market. When I joined, I started really thinking about digital assets as an asset class. And I kind of just went through the mental model of what that would look like. Why is this unique? Does the technology work, etc.? And I came to this conclusion that it's a really interesting asset class, which is a lot more technologically imbued, a lot more dynamic, and could kind of lead to a lot of different interesting areas and products and outcomes, basically because of blockchain. And so with Clanz, we have now embarked on a journey to become a premier digital asset management firm. So we're going to start releasing investment strategies. We're going to start to move into this space with thought leadership, with very careful and well-articulated arguments. We don't want to mislead people. We also don't want to propagate this kind of gambling mentality. I think that's taken a lot of crypto world to this point. And we really want to kind of start to think about institutional adoption, wholesale adoption, which we're seeing around the world. So we're seeing a lot of early signs of that. Lots of trading desks being set up, lots of capability being brought online. But I feel like there's a lot of interesting depth to this space, which is yet to be explored. So I wouldn't want to just import an equity research model, for example, and then put it in here.
I've been working in finance for 25 years. I think all parts of finance are varying degrees of gambling, if you will. So they're more controlled so that, the risk isn't as, free flowing, but everything, I started thinking that back when long-term capital management failed. So, we live in such a tumultuous environment. So,
Look, I mean, and let me just pick up that quickly point. I think you're completely right. I think the slight difference is that with crypto, because anything that moves so fast, like people buying Tesla cars and changing the course of their life because they bought some weird thing called Bitcoin 10 years ago, it really induces this sense of fear of missing out, FOMO, and therefore people go into it a bit like the tulip mania as a way of making short-term returns for no understanding, effort, research. Where I think a lot of the asset management world and finance world stresses the idea of risk returns, stresses the idea of long term, stresses the idea of all these things. But in both of those cases, you're 100% right. You're still betting on a future outcome of some kind. And when people criticize Bitcoin for having this kind of pyramid scheme kind of characteristic that you're just waiting for the next person to buy the asset from you, there's plenty of examples you can give in finance where entire investment processes and fortunes are built on hedge funds doing exactly
we're
that.
living in a very volatile world. If you look at TLT, the ETF for the US 30-year Treasury, you're talking about volatility of 30-40% drop in the last 6 months to a year. That's penny stock type drops, but that's US government bonds. Everything goes left and right now. We have so much more volatility. It's something we're gonna have to live with, I think, for a very long time. So inflation, do you think that's going to be good long-term, bad long-term for the crypto world?
So it's a very interesting. So lots of I have a sort of a slightly longer answer to this question. So buckle up. But people talk about Bitcoin and crypto in very, very macro terms. I see them kind of talking about it as storage of value, as a proof against inflation, as all these kinds of things. I think on a fundamental basis, you can say that they were maybe built like this because they have limited supply. But in terms of their trading and their behavior, and they behave, as I said, like small cap tech stocks. So controversial. That's why people kind of point out the fact that for something that's meant to be digital gold, in the current market environment, they've all been trashed. Like, almost every single cryptocurrency is down, along with the technology sector, as a kind of high beta play on that area. And that's simply because the way that they are behaving, the way they're trading, the way that people are perceiving them and co-holding them is with this high-risk tech stuff, which is it's an early stage technology. So all that makes a lot of sense to me. If I look at the current inflation, there's a whole other conversation as to where it comes from, the supply side, the broken supply chains, the energy, and so on and so on. I really see very little to do with what's happening in crypto, aka business failures and these market movements and the correlations to the overall market. And I see almost like two orthogonal conversations where some of the causes of inflation, for example, and supply chain issues could be improved by the use of blockchain technology and potentially by some usage of cryptos and tokens. And that's an interesting adoption of that technology as a way of sharing data and making sure that the system is very fluid, as an example case. But in my mind, that has very little to do with the idea that Bitcoin should be a better currency and that we should transition, milk and bread and cereal and oats to be counted in units of Bitcoin and therefore avoid inflation altogether. I mean, I don't think that's reality, and I don't think that's near-term reality. So again, lots of interesting narratives on Bitcoin. You hear about macro forces and characteristics it's supposed to have. Maybe at some point it did have it, maybe not. In its behavior and its functioning, and the reason we're even talking about it today in a popularity is certainly not because it's a really good inflation hedge or it's a really good defensive asset.
We'll get to a point, though, where the sellers exit the building and the buyers come in, and the price will move. I mean, look at petrol. In the last 10 years, as high as 147, as low as negative 35, whatever it was during the COVID meltdown of crude, and now back to 115. So you're getting such ridiculous movements in these gigantic global commodities that I think volatility will just be everywhere. Stocks, bonds, left and right. People will need money and then they'll pour back in, and we'll have passion. Hobbes will be right, and that the passionate human is essentially the stupid human, and the passionate human will take over the financial markets.
And I think that's so. I came last week. I went to Austin in Texas, and it was at the Consensus Conference, which is a global blockchain conference, 15,000 people.
No, it looked just amazing. I was so sad.
It was crazy. It was crazy. And it's somewhere between like a rock concert and and an actual conference. So it's kind of elements of both. We had Snowden, obviously not in person for obvious reasons, as well as CEO of Bitcoin, and sorry, Binance and a few other institutions. But what was really fascinating for me to see is that for whatever reason, the people in that room and everybody coming through, as you say, were believers, right? So they were kind of driven people, driven to build, driven to get through this next period of time. There was very few of that short-term cut and run, oh, I can't make any money, so I'm getting out of here, in the kind of core group of this community. And that was amazing to see. So you kind of get this sense that the technology is superior. We know that blockchain is superior. We know that some of the applications are very strong already. So the DeFi or the centralized finance, the trading, the exchange, the wallet, and is very powerful as well, and a whole bunch of other technologies around that. So if you know that technology is better simply than what we have, and there was fascinating conversations in that conference around if money was a product, then that product kind of sucks. We need a better product, aka we need a better version of this thing called money. And whether that should be private or public sector kind of good and those kinds of things. But if you believe that technology is here to stay, then you understand that the capital markets will ebb and flow. And you understand that in these periods, it's actually a really good time to consolidate, to learn from mistakes, but also to do acquisitions. And this is where you're starting to see companies finding partnerships. We're certainly on the hunt for partnerships globally as locally as well, to think about how we create a better product range to become a more resilient player, so that when the next upcycle comes, and it will come because, again, it's a better technology and the kind of core resilience of the people involved is great. And the amount of money that's in the sector is huge. And you certainly have a sense that when you add all these things together, you have an industry of the future that is kind of going through some tough times right now, but it's not going away.
And when it goes up rapidly. It was $10,000 a coin in the summer of 2020. And then 6 months, 9 months later, it's $67,000 a coin. So let's keep with the trend of the show, which is we live in volatile times and everything's to move, with extreme volatility.
And it's a really interesting way to think about volatility, Alex, which is the other way to think about volatility is time is compressed. So as you said, stuff that would normally take 3 years to happen happens in 6 months. So essentially, time is pushed together. Things are moving so fast, and often different kinds of things. So it makes it challenging to keep up with the news, to keep up with what we think, etc. We're seeing kind of once in a 30, 40 year events left, right, and center in terms of inflation, interest rate responses, etc. And I think for those of us who have been through financial crises and downturns, we know that there are discernible patterns as to what happens now for the next few years and how things will kind of clean out.
Dr. Kollo is one of the more brilliant minds I've come across in the last 25 years of finance, and I encourage you to follow him on LinkedIn and check out his company, Clanz. There will be another crypto sunshine. I want to learn more about crypto. I still know very little, but I see the passion in my students, and the passion rubs off on me. And thank you so much for coming on today, Dr. Kollo. This was really fantastic.
It's absolutely my pleasure, Alex.
Be well, and I hope you make the Cornell conference in the fall.